still the balance sheet play, although it has a negative impact on the valuation of many businesses because you're wearing risk on book, uh, it is an area that many of these firms end up gravitating to because if you look at what is that fundamental need among the long tail, credit is always front and center as a priority. Because while it's marketed as a public good and it is technically free, you still need to think of what are the incentives for financial institutions to push this and how do they make money? And therefore, what are the incentives for the end users to actually use it? This is what people are defaulting to. And I just fear it's like, is there any part of your brain that you want to leave to do a job? Or
That was Ben Quinlan, CEO and founder of consultancy Quinlan and Associates. We had a wide-ranging conversation looking at the past 10 years in fintech across payments, wealth, blockchain, AI, and I think we came up with some interesting ways to think about what's going to come next. My name is J.DB Report, and this is my report. Ben Quinlan, welcome to the program.
good to be here, James.
So this is a kind of a special version of our report. You have recently celebrated 10 years at Quinlan and Associates, the firm you set up. So congratulations.
Thank you.
And I've also been about 10 years focused on fintech as a writer and media producer. So I thought maybe this was a great opportunity to take stock of some of the biggest themes that we've witnessed over the past 10 years. And perhaps out of that, we can get one or two ideas about what to look for going ahead.
Yep, absolutely.
So do you have a big theme? Do you have one thing that just when you think about 10 years of fintech that hits your mind in terms of what's been the biggest change or the biggest event?
For me, I think the coolest thing is when I look back I remember the early days when we knew each other, and a lot of these ideas in fintech were just that. They were ideas, they were notions about how finance could be done better, whether it's digital, branchless banking, real-time payments, money via your telephone. And the greatest thing is we've seen so many of those early ideas come to fruition in terms of real life businesses and impact. And the promise that had been put in the market a decade ago in terms of better customer experiences, in terms of cheaper, faster, more efficient, whatever it is, to better resonate with the young generation and the underbanked populations and so on. A lot of that has actually come true, which is great to see. So in COVID, I think that was the big boost for all of it, because many of these ideas were still in inception, but that rewiring of the human brain, forcing us to do everything online, was, I would say, the biggest tailwind that fintech could have welcomed. And it was great to see that change in behavior. You've seen now, the digital banks. I remember Hong Kong was one of the first cabs off the rank, right? And you see them, 2.5 million Hong Kong people are being serviced by the 8 digital banks here. Profitability is another story. We can unpack that completely separately. But at least the hope of what it was trying to solve and the pain points it was really addressing, many of these businesses have proven that there is genuine demand from end customers about using this new form of digital finance.
One thing I've seen that has changed over that period of time is 10 years ago, there was a lot more talk about disruption.
Mm.
That all these things that did come true were also like, well, you don't need a bank to do any of this. Um, and I think we've seen that level of rebelliousness, that kind of we're going to take over the world and get rid of these old, shoddy incumbents, that hasn't happened. What's happened is there's been sort of the incumbents where they needed to, they adapted and they either acquired or co-opted or used their advantages of balance sheet or regulation or whatever to sort of take over large sections of the fintech. So do you still see pockets where that disruption call to that call to arms is still meaningful?
I believe there's a lot more rational thinking around frenemy environment rather than direct competition. And it's been clear that different business models can coexist, catering to different kind of end customers. I remember the big promise about the let's disrupt wealth management and private banking with these new digital robo platforms, especially in a market like Hong Kong, which is super high touch and driven by very, very deep relationships with the relationship managers and the high net worth individuals and so on. You have seen the take up of these solutions be a lot slower than the actual notion of, well, it's cheaper to manage my money this way. Why wouldn't I do it? So there is still a place for advice. Even I think you remember a report, the infamous report we wrote a few years ago around digital direct insurance,
Hmm.
right? Um, Logically, sure, let's get things 30, 40% cheaper on a like for like basis in terms of premiums. But that's been a really hard market to crack in terms of getting to a certain level of critical mass and breaking the moat that incumbents have. But you have also seen areas where the moat has been broken. So traditional business models of brokerage, which is just pure vanilla trading. The idea of calling up a relationship manager and executing a trade for you and paying them 40 or 50 basis points, that's gone. So it started with the retail wave, but now when we speak to all the private banks, it's very clear that that vanilla trading business either needs to be done pure digitally or the business is going to these low cost platforms. So there are elements where I think fundamental disruption around business model has occurred, but there are other ones where I think, there is still a generational shift required and old habits die hard. So,
Yeah.
certain customer groups aren't necessarily attuned to doing everything digitally on their phone. They still like in-person interaction to some degree.
Yeah, one area where we've seen a difference where everyone's had to adapt is when you introduce the notion of a platform, then all of your silos are no longer interesting siloed verticals in finance. They are just widgets that plug into the platform. And then the economics go to the platform as the new distribution mode rather than to what might have been your traditional uh, means of selling, whether it's loans or funds or what have you. Um, what have you seen in terms of, there's whether it's, uh, like Grab, which has this in Southeast Asia, has an enormous reach into ordinary consumers, and through the ride-hailing side, is probably just the one that pops into my head is sort of like the obvious example of a platform taking over large parts or growing the pie, not necessarily booting people out of traditional businesses, but growing that pie into segments that were never really served well and now are getting lots of services because that platform economy. But that's not necessarily one where the traditional lender or other institution will be able to maintain or achieve for itself the kind of margins that it ever enjoyed with its traditional business.
That's right. So the holy grail has been to develop the super app play, but not easy. If you want everyone to do their whole daily life, their purchases, their consumptions, their investments, their loans, all through one single unified interface, the idea in principle is great. But again, what I would say, and it echoes your point, a lot of these businesses were catered towards very long tail customer segments, and long tail customers equals critical massive volume, but much lower unit economics. And for a lot of the traditional incumbents, their view was, well, we can't go down that pathway because scalability of servicing these models and these high touch models with long tail just isn't there. So
Right.
we can never achieve that unit economics. But many of these businesses have also faced their challenges about achieving profitability because the monumental task to scale is expensive. The technology that is required, particularly as many of these firms use third-party technology costs scale with that user base, right? So how do you ensure there's enough margin and protection in there to make this worthwhile? And when you mentioned the concept, for example, of lending, still the balance sheet play, although it has a negative impact on the valuation of many businesses because you're wearing risk on book, uh, it is an area that many of these firms end up gravitating to because if you look at what is that fundamental need among the long tail, credit is always front and center as a priority.
When it comes to profitability, we've seen as you say, it's very difficult. I mean, Grab infamously SPACed in the US, and then its share price continued after that, got hammered, along with many of the other fintech companies that went for a listing because the profits weren't there. At the same time, in China, we've seen the rise of the super app, and you've got Alipay and WeChat Pay based and everything based around these two things. But that has not been, and they make a lot of money, but that is not sustainable or repeatable elsewhere. So I think this question of the super app has turned into a bit of a dead end in other markets. It's basically really the China model, maybe Kakao Bank in Korea. But other than that, I think you'd have to look to maybe like something like a Pix kind of wallet in Brazil or something, or a state-run public infrastructure like UPI in India to find any. But these aren't, these are very different kind of models. I think the super app concept, we got very excited about what was going on in China and realized that it only really works in China.
Well, I don't know if it's just in China. I think you mentioned the idea of Kakao. The reality is the super apps that have done it very well had the mode of customers because they were the communication thread. So when you have a critical mass of a customer base, the discussion is about conversion rather than acquisition. So how do we get our users that are using us every day to gravitate towards using our financial products and services? Whereas if you move to a more, ground up business model, one of the biggest drawbacks for many of these firms is how to acquire customers at scale without burning through cash. And the payback period to actually monetize this has been extremely long for many of these businesses. Because especially in Asia, people are smart. They're deal seekers, they're deal hunters. So when people are offering rewards and cashbacks and here's a free suitcase to sign up, or there's a lot of people that would sign up, take the reward, and bugger off.
Right.
And we saw that so much, and that actually transpired to really high dormancy rates with many of these businesses that had these big swaths of customers, but many of them weren't actually active. So then it was, okay, we've solved for acquisition. I always said to any client, we can easily solve for acquisition if you're prepared to spend the money. But how do you solve for smart acquisition? And remember, if your active user rate is only, let's say, 20%, then your real CAC is 5 times the amount that you've actually spent. That's your effective CAC for a proper customer. So thinking through a customer journey in terms of, yes, I acquire, but what does good look like? And how do these customers actually stay with the platform? And how do I monetize them beyond just bringing them on board? So the examples you gave, Kakao, China, WeChat, Ali, they had the native communication messaging app and a massive mode of customers. So I think those were different. And I think most of the models where you have that customer base to start with, it becomes a lot easier to develop a super app proposition rather than from the ground up.
One of the trends I've noticed over the past decade has been the growth of access. So financial inclusion, I guess, is the catchword. And sometimes I'm a little skeptical about it because it can lead to exploitation, like buy now, pay later, and
Yep.
levering debt onto people that may not really be understanding it or should not be in a position to borrow like that. But broadly speaking, if we look at the way that payments have really expanded from purely cash and cards to wallets to real time, and we've seen across the region and the world, governments, creating conditions for essentially mobile-based, real-time, free or almost free payments. And so, some of that is much more top-down, like in India, but even in Hong Kong or Singapore or anywhere, Australia, anywhere, you've got these, just on your phone, and in within ASEAN and the region, in very stop-start methods. But there's also the beginnings of where you could take your own debit account essentially from one country and use that to spend directly in another. So
Mhm.
this seems to have broadened. The amounts are capped. These are limited in what you could do with them, but that I think that this has been a huge expansion. It hasn't replaced cards. It's rather become a new ecosystem that exists side by side with the incumbent rails. But I'm curious if you think that over time, if some of these things have the capacity to become so big that they could actually become themselves a challenger to like the Visa and MasterCards of the world.
Hmm. Very interesting topic. So the whole idea about the evolution of payments. So if you look at it from cards, e-wallets, have like FPS in Hong Kong, price shifting down, 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 down. So for a merchant in particular, or a business accepting these kinds of payments, this is a real boon. It's a great thing. But again, it needs to reflect what the end customer wants. That is all that matters. And the reality check is, how do you and I make decisions around what payment method we use? And there is a war going on in terms of miles, cashbacks, rebates, which consumers are highly sensitive to. And we can gravitate towards using certain payment methods naturally because it provides us with the most benefit. So we're not silly as consumers. So we're going to vote with our feet. It's that simple. If I give you the most logical example here, the card's still 2-3% fees, right? E-wallet's about 1.5, FPS is 0. The lower your fee is, the less room you have to provide the incentives to encourage that switch in behavior.
Yeah.
And without customers actually engaging in these payment forms, you as a merchant are beholden to what your customer wants. It's really as simple as that. If I draw a parallel to the world of central bank digital currencies, you've seen so many of these retail CBDC experiments happen around the world, and many of the pilots were put on pause or canceled. And the ones that have rolled out 4 or 5 jurisdictions globally, the adoption and uptake has been really poor, because while it's marketed as a public good and it is technically free, you still need to think of what are the incentives for financial institutions to push this, and how do they make money? And therefore, what are the incentives for the end users to actually use it? And particularly in a market like Asia, where people are very price sensitive and sensitive to value, they will be gravitating towards mechanisms of payment where they get the most reward. And this is why, even in Hong Kong, you've seen every year just the amount of credit cards in circulation in Hong Kong keep going up, and they are still the dominant form of retail gross merchandise value from the end consumer in Hong Kong. They make up about half of the GMV here, and that position hasn't moved that far.
I'm glad you mentioned CBDC, because to me, one of the most fascinating stories over the past decade has obviously been crypto. Um, Bitcoin is earlier, 2008 or so, but really that it became really probably about 10 years ago is when it began to really take off, and the prices went up above $1,000 for Bitcoin and so on, and we had um, this notion of disrupting the banks, or of creating a really a different financial system built on completely different principles, really took off. A lot of it was corrupted by a profusion of short time get rich quick artists, some of whom got very rich indeed, and then a few who kind of blew up the system once or twice. But nonetheless, the idea is there, and now we see institutions wading in, getting licensed themselves to issue stable coins or to participate in, they're looking forward to using the mechanics of blockchain technology to clear away settlement layers and reconciliation layers and settle instantaneously. But I'm not sure that they're offering a product that the broader market actually wants. So this question mark of, will there be a real disruptor to the status quo? It looked for a time like it could come from crypto. Now it seems the banks are co-opting this, but it's still there, and it still has some power to it in terms of being a little scary for banks to handle anything that goes too far into the world of DeFi. So I'm just curious about how you see that, and if you think that crypto, Web3, DeFi, whatever moniker you want to use, is going to continue to play an important disruptive role, or if it'll just remain, this kind of casino that's kept on the sidelines and won't really make a difference in the long run.
It's always been a casino with an evolution towards understanding how the technology can be applied in traditional financial world. So, the iterations and evolutions of the Web3 industry over time, from the initial ICO wave to IEOs to STOs to NFTs, these are all products that have launched, struggled, toppled, reinvented, remarketed themselves. The great irony about all of this is that an industry which was designed to point the finger at financial institutions saying, we don't trust you, has defrauded people out of so much money. I can't believe it. But financial institutions do understand the benefit of using this technology precisely because of the elements you're saying, 24/7 liquidity, removing settlement layers. There are distinct benefits, but the challenge here is that the traditional pool of investors into these instruments have been ones seeking outsized, insane gains.
Yeah.
And as soon as you create a wrapper or a tokenized wrapper around a traditional financial instrument, you almost anchor the investment returns now into reality, and it's
Right.
no longer about hope. So that has very little attraction to the traditional crypto investor. But then the argument is, does this provide an avenue towards institutional money where they would be comfortable investing in these kinds of products because there are elements of cost that are taken out? There's enhanced liquidity. It's very debatable. And I think we have seen, for example, the launch of the virtual asset trading platforms in Hong Kong. There's an insufficient level of product depth, in my view, and participation to drive liquidity to make them successful at this point in time. And you compare that to the more traditional style crypto exchanges like a Coinbase and Binance that are just printing money every day. So how do you find that middle ground? It's interesting. Stables are going to be one of the instruments that provide that bridge between Web 2 and Web 3 worlds. If I ask anyone who wants to launch a stable, sure, they just want to make interest on the float. The case for them is very clear. You give me your money, I invest in treasuries, I take the interest on that, and I'm not allowed to share any of that back with you, right? So that's a great business.
Yeah.
But how much this is going to actually make its way into daily life, there's still huge elements about mistrust that exist in Web3 land. And as strange as it is, when there is a bogus transaction that happened on my card 2 weeks ago, there is still some assurance that I'm protected by the bank. As ironic as it is, that I appreciate having a financial institution for the layer of trust and security there, despite all of the criticism pointed at traditional finance over the years.
We're coming to the end of our chat, Ben. Since we're talking about the future now, the past couple of years have been dominated by AI, in particular generative AI, and the use of these large language models. Uh, I hear from a lot of the startups and smaller, nimbler companies, digital banks, and so on. Their CEOs say that they are, instilling a new culture. Everybody's got to be using tools and come up with ways to improve their productivity. Um, the enterprises are obviously keen to figure this out, but they have some issues with what they can do. Sometimes these guardrails are very sensible, sometimes they're
Yes.
bureaucratic. Just curious if you've got a view on how you think this will play out.
I think AI is going to be the biggest disruption that we have seen. And I would say maybe 6, 12 months ago, I wasn't as concerned because a lot of these tools it was co-pilot mode, right?
Mhm.
It was basically your buddy, your assistant, someone to bounce ideas around, help you think through, structure some thoughts.
And it's still a Microsoft product.
Yeah, exactly. And now we're seeing this evolve into what is autopilot mode. So the idea of agentic AI and being able to create clones, avatars of yourself, responsible for very distinct functions with very distinct skill sets that reflect your DNA. So the idea of this building your second brain now, it's a relatively new concept. How do you train your second brain to have your voice, your way of thinking, and so on and so forth? So this is going to be a big game changer. I feel very sad in some ways because I wrote an article on this quite recently, and I've said AI has trivialize decades of mastery into a single prompt. And it's done through stealing a lot of the intellectual property that's provided by the original LLMs, which is firms like us, which is the inputs into these large language models. So I just think it's a steamroller that's not going to stop. And I do think you're going to see more and more firms look to adopt this and understand that the potential here is not just about supplementing their existing employees and working out how to make them more productive, but fundamentally take them out of the equation and reduce the cost base.
Do you see AI in that as something that is obviously going to be massive, transformational, and important for good or for bad for the people working within financial services or at a fintech or at a SaaS company, but this question of how we get our financial services delivered to us, is it by a bank? Is it by something else? Will that remain status quo? It's just that the banks and fintechs and so on are using this and fighting in a different way. Or are we going to see, do you think there's a possibility that we will get true disruption and this will mean that many financial institutions, incumbents who were quite comfortable with, say, riding the blockchain wave and so on, or the fintech user interface wave, will find this, really either puts them out of business or forces them to really create a very different value proposition.
I think it's the latter. And again, I think you're seeing this with, so let's just take it out of finance for a second. I think there's a lot of businesses, copywriters, musicians, like so many areas of business that now it's almost like everyone's converging on relatively good. Even when you do a post on LinkedIn, you read through and you go, wow, everyone just knows how to write and write in the same style
Same
right now.
style.
So the same post again.
Breathless. You must know this. You're an idiot. Yeah, that kind of style.
Yeah. But
Super annoying.
yeah, it makes me, well, it feels sad in that way because these are genuine skills. And I would say there's a cognitive dissonance that's going to happen between people's digital and online personas versus meeting them in real life, where you basically say, oh, well, everything that you had impressed me about because of the fact that you were using so many of these tools clearly don't translate to a boardroom or when I'm in person with you. But that's going to matter less. If I think about, how people are going to conduct their daily activities, are you really going to go, like, there's going to be a whole new wave of people. And I don't look at the older generation when I'm thinking about what's going to happen in the future. I speak with the younger generation. That's all I do. How are you guys doing this? How are you going about these activities? And people will be using these large language models to say, this is my financial position. I'm thinking about this, construct a portfolio. How would you recommend this investment strategy? You can ask it
Yeah.
anything. And more people will be defaulting to these kinds of solutions. And this is all well and good until things go wrong. And obviously, people still want someone to blame, still want some kind of a check and balance. And that's where financial institutions come into play with potentially that trust layer. But it is going to change a lot, James. It is going to disrupt my industry. It's going to disrupt a lot of other industries. And the trick is how we use it in the right way. Because again, if you're doing your strategy by prompting GPT, what should your strategy be? I think you're going to have some severe problems in terms of being able to come up with something credible.
Yeah.
And again, the devil's in the detail. And a lot of the time, the detail is either missing or highly inaccurate. This will change. It will get better over time. But yeah, expect some massive changes along the way. The last point I want to, I guess, pick up on is the interesting position that Hong Kong's in terms of the usage of the large language models, because we're stuck between, do we use the offshore LLMs with like a VPN connectivity or like an offshore hub that's accessing and subscribing to it, or are we using the Chinese large language models? And depending on which company, you're going to be stuck between a rock and a hard place. So this layer is also an interesting dynamic in terms of where Hong Kong specifically sits as well.
Um, And at some point, we're all basically being subsidized using these
Yeah.
AI tokens, and we don't know what that's going to look like, but we can pretty much guess the price is going to go up, and so that will have a big impact on everyone in terms of how dependent they become on these and what it means for their businesses. So that
Very
would be
true.
healthy.
Once that reliance gets to a point of there's just so much inertia, it's very hard to unwind,
Yeah.
then yeah, a lot of these companies can start naming their price.
Yeah, I think that there will be some. I think we'll see some exciting new stuff that will continue to broaden out that financial uh, access story to a
I
lot of
think
people.
so. I think so. I think when it comes to financial institutions, there's still a heavy human in the loop emphasis, right? And it's there as a productivity assistant and tool. So letting it run agentically, I think the good thing is when you work in a regulated industry and such a highly regulated industry, you can't outsource the blame of anything to technology. So the checks and balances that are required and the human judgment that is required is still there. But I would say that does everyone need a human in the loop? The key thing will be no, there are still humans in the loop, but do we need everyone in the organization to operate in that capacity? I think you will need fewer humans, and then you will still need the loops and checks there. But a lot of the core work definitely can start to be automated, and a lot of these costs can be taken out, especially in the short term when tokens aren't too expensive.
Yeah. I think the differentiator is the liability piece.
That's
So
right.
what are you on the hook for? And if you're a fintech, maybe instead of having a super light model, the future model for sustainable profitability could be to take on more of the nitty-gritty tasks alongside. So using AI to super scale the software offering, but if you can take on these difficult things that software can't address, liability being one of them, then perhaps that's a new kind of model that we'll see.
Yeah. Yeah, well, again, I think the biggest risk that people face here is this over-reliance, which will create a wave of what I call intellectual atrophy. It just causes intellectual laziness along the thought process. All of us have standard processes that we go through when we generate work, regardless of your role. So you need to think through the ideas, you need to brainstorm, you need to then research, find the information, gather it, synthesize, analyze what it means, put it through to a piece of your work, a recommendation, a piece of output, a piece of writing, whatever. And that process, that it's like the whole value chain can now be outsourced. It's like Google gave you the map, it pointed you in the right direction, but you still had to download things, read them, digest them, understand them, go through the painful drafts, editing, and so on. So my fear is in 10 years from now, there's going to be people in management that have never had the experience and the baptism by fire and the apprenticeship to understand what good looks like. So when we talk about human beings, their value comes from judgment. Judgment is built from doing and from that skill. So if you remove us from that, if you remove that training ground, and you have someone 10, 15 years in that can produce something beautifully AI generated, my view would be, is that correct? Is it good? The capacity to understand and work that out, the only way they could do it is to ask AI again, is this good? What's wrong with it? And unfortunately, I think the gravitation will be much more towards that direction. And you're even seeing a lot of the marketing happening right now on my Instagram, forcing like, this is how you make your LLM critique you. Don't just accept what I say as given or great idea. Be the challenging person. This is what people are defaulting to. And I just fear it's like, is there any part of your brain that you want to leave to do a job? Or is it everything, including scrutiny? Because that's the one thing that we say has value, but the second you outsource that, I don't know what we have left.
Well, I hope that anybody listening to this conversation will be inspired to make sure that they continue to do their own work and and do the work.
Exactly.
And most importantly, make sure that the youngest people coming up through the ranks in your company are given the opportunity or required to also do that work.
That's right. That's right.
Great. Ben Quinlan, congrats again on your firm's 10th anniversary, and thanks for joining me on the program today.
Thanks so much for having me, Jane.